All right, let's dive in. Today, we're going to get right to the heart of a huge question that every single business has to answer if it wants to survive. Are we actually making money from the stuff we sell? We're going to break down something called the trading account. It's the tool that really tells you if you're in the game or not, at the most basic level.
You can think of a company's finances like a big, complicated game. You've got all these different moving parts, but none of it matters if you're not putting points on the board. The trading account, well, it's like the main scoreboard. It cuts right through all the noise and shows you one simple thing: the profit a business makes just from buying and selling its main product.
So let's put ourselves in the shoes of a business owner for a second. Before you even start worrying about things like rent or marketing or paying your office staff, you have to answer this fundamental question. Is the product itself profitable? If you sell a t-shirt for 20 bucks, did it cost you more than 20 bucks to buy it and get it ready to sell? That is the essential puzzle we're going to solve today.
So what's the tool for that job? Well, it's called the trading account. It's the very first chapter in a company's end-of-year financial story, and its only purpose is to figure out the profit from buying and selling, and nothing else.
So what is it really? Think of it like a special kind of calculator. It takes in a bunch of numbers and spits out one of two results, either a gross profit or a gross loss. Now that word gross is super important here. This is not the final amount of money in the bank. Nope. It's the raw, unfiltered profit from the main thing the business does before any other expenses have been taken out.
And you've got to understand the difference between gross profit and net profit. It's absolutely crucial. Gross profit, the thing we're focused on, is just revenue from your sales minus the direct costs of those goods. Net profit, that's the bottom line. That's what's left after you pay for everything: rent, marketing, salaries, the whole shebang. For today, we're laser focused on that first number, the gross profit. Okay, so to get to that gross profit number, we've got to build this thing, the trading account. It has two sides, and we're going to start on the left, the debit side. This is where we track all the costs that are directly tied to getting your products ready for sale.
And here's what it looks like: a classic T account. All you need to remember is this: debit on the left is for costs. It's where money flows out. Credit on the right is for income and value. It's where value flows in. Simple as that. So let's start building out that cost side. There are basically three big things that go on this cost side. Let's imagine we're running a business, Clara's T-shirts. First, opening stock. That's the value of all the unsold T-shirts she had sitting in her stockroom from last year. Second, net purchases. That's all the new shirts she bought this year, but we have to subtract any she had to send back to her supplier. And third, direct expenses. Which brings up a pretty good question: what exactly is a direct expense?
Okay, so direct expenses. These are the costs you just can't avoid if you want to make your product. For Clara, think about it. She's got to pay the people who are actually printing the designs, right? That's wages. She has to pay to get the blank shirts delivered to her workshop. That's what accountants call carriage inwards. And, of course, the power to run the printing machines. It's not her office phone bill, it's costs tied directly to making the t-shirts.
And just like that, our debit side is built. We've got our opening stock, what we bought this year, and all those direct costs. This whole side basically tells us the total cost of every single t-shirt Clara had available to sell throughout the entire year.
Okay, cost side, done. Let's flip over to the other side of our scoreboard, the credit side. This is all about the value we generated from our sales and also the value of the stuff we didn't sell.
No surprise here, the star player on this side is sales. But we have to be careful. We can't just count every dollar that came in, because what if a customer returned a shirt? That doesn't really count as a sale. So we use net sales, which gives us the true honest number of what we actually earned.
Now, the next item on this side is a little weird at first glance: closing stock. These are Clara's unsold t-shirts at the very end of the year. So why is it on the credit side, the value in side? Well, think about it. We haven't sold those shirts yet, so we can't count their cost against this year's sales. They're an asset. Their value gets carried over to become next year's opening stock. Putting it here is a clever accounting trick to make sure our numbers match up perfectly. And there you have it, the whole blueprint. On the left, everything it cost us. On the right, what we earned plus the value of what's left over. It's perfectly balanced, conceptually speaking. Now for the fun part. Let's plug in some real numbers. Okay, this is the moment of truth. We've got the framework. Now let's see it in action with some actual numbers from our source material and find out if our business is a winner. So our source gives us this handy example, illustration 1. It's got all the data we need. Opening stock, sales, purchases, you name it. We're just going to take these numbers and drop them right into the T account we just built.
First up, the credit side, the value side. We've got net sales of 1,570,000 rupees. Plus, we've got that unsold closing stock, which is worth 20,000. Add them together, and we get 1,590,000 rupees. That's our total value generated for the year.
All right, now for the debit side, the cost side. We take our opening stock, add in the net purchases, and toss in those direct expenses. The grand total for all our costs comes out to 1,003,000 rupees. So now we have our two big numbers, the value we generated versus what it cost us to do it.
And here is the magic. This is where it all comes together. The value side is bigger, right? It's 1,590,000. The cost side is only 1,003,000. They don't match. So to make the two sides balance, we have to add a number to the smaller side, the cost side. And that balancing number, that difference of 587,000 rupees, that is our gross profit. Bam! That's the money the business made purely from its trading activity.
Okay, that's awesome. We have our number, 587,000. But so what? What does that number actually let a business do? Why is it so important?
Think of the trading account as a report card for your core business. It tells you, straight up, if you're actually any good at buying and selling your product. Is your pricing high enough? Are your direct costs, maybe your suppliers, getting too expensive? By looking at this gross profit number year after year, you can spot trends and make really smart decisions before it's too late. It is absolutely fundamental. And you know, this whole thing is really just the first step. As our source material points out, this gross profit number isn't the end of the story. It's the starting number that gets carried over to the next big financial statement, the profit and loss account. And that's where you find the final, bottom line profit. So I'll leave you with this question. Imagine this was your business. You just ran the numbers and you're staring at your gross profit. What's the very first move you make? Do you look for cheaper materials? Do you think about raising your prices? That one number opens up a whole world of strategy. And that's the real power of the trading account.